Hello, welcome to this video. I'm going to be talking about credit ratings on this video. Okay, what is a credit rating? A credit rating is basically an opinion on the credit risk of the company that is being rated. Okay, very important in the financial sector, the banking industry, because people who are lending money to companies, whether they're banks or other companies, may well be interested in the ability and the willingness of that borrower to repay the money in full and on time. So, for a third party, neutral, independent view of this ability and willingness, they may go to a credit rating agency. Okay. And the credit rating agencies, you get them in every country. The well known ones are the three global ones, multinational globals, very well known, of Standard and Poor's, Moody's, and Fitch. Okay, but there's every country has its credit rating agencies, or just about every country, and of course some are more well known than others. Now, the reason a lender of money, an investor, will be interested in a credit rating of a firm or a bank, any entity that's borrowing from it, is because they want to know what the risk is, the extent of risk is that they might not get their money back, and that's why you may already be familiar with the rating scale of that the rating agencies um, publish the ratings are based on. Unless if you're already familiar with it or not, it starts with say that the risk, the lowest form of credit, the credit rating, the highest form of credit rating, almost risk-free, known as triple A. So triple AAA, S&P, or they're all triple A, but Moody's has the second and the third A's in lowercase. So S&P, Moody's, Fitch, or indeed a lot of credit rating agencies around the world will reflect their lowest form of credit risk as AAA, all the way down to triple C, or in the case of Moody's, CAA2, and that's the highest risk, lowest credit rating. There is actually a rating of D, which means for default, but of course by then you've defaulted, so you're going to struggle to borrow money from somebody. Now, these ratings are applied through a process whereby the company that is wanting to be rated, they're the ones that want a rating because it will help them borrow money from investors. They will approach the rating agencies and go through the process of getting a rating, and it's quite involved. It's actually a very interesting process. I've had the pleasure and the privilege of working with a number of rating agencies, all three of the main ones, and a number of others during my time. And the process involves basically the rating agency in effect running its slide rule over the firm, and the type of things it will consider are from the top, the strategic objectives of the firm, its direction, its competitive environment, its balance sheet strength, the amount of capital it has, the quality of its assets, its funding profile. We're talking about rating a bank here, its own risk appetite, its performance historically, how strong it is in its customer base, what's its market share, how good is its management. So it's not just about looking at the balance sheet and doing a quantitative analysis, it's also about the strength and the experience of the management, the current economic conditions, the current competitive landscape. All of these are key determinants in the rating agency process, in the credit rating process. All three of the main agencies have a kind of peer comparison as well. So, if we were to consider just randomly, just by way of example, Standard and Poor's rating methodology summary, they'll look at the macroeconomic factors, they'll look at the firm-specific factors, they'll look at the country factors, and then they'll look at the all of that together and come up with the rating for the firm. And in effect, what the credit rating is, it's a letter that encapsulates a default probability, really. So AAA rating means it's got a very low probability of default, and triple C rating means it's got a slightly higher probability of default. And having done the process of analysis and looking at those key determinants that we just mentioned, it will then issue its rating. You can make that public or you can keep it private. And of course, the higher the rating that you get, the more incentive you will have, presumably, to make it public. However, something I find myself frequently saying to bank treasury and finance people and alcos of banks is even a low rating has value, because the rating process involves a third party coming in and examining all your data, your balance sheet, talking to your management, looking at every aspect of your operation, conducting an analysis of the external and the internal environment that the bank operates in or the firm operates in, that's the firm that's being rated, and it comes up with an opinion. And that process requires discipline. The senior management would have presented to the rating agency. They would have given up data for them to look at, and the rating agency is looking at that and saying, okay, here's our credit rating. So even a lower rating, say sub-investment grade, if you look at that rating scale chart again, anything below triple B is considered sub-investment grade. But even if you're a firm with a double B rating, does that mean you wouldn't publicize it or you don't want the rating? My personal opinion is no, because it shows you've gone through that ratings process, and that has value in itself. Often I tell people looking to borrow in the wholesale money markets, if you are non-rated, some institutional investors looking to place short-term cash, so looking at the short-term rating, may be more inclined to place with a lower rated firm than a firm that has no rating, because it shows they've gone through that process. So even a lower rating, a sub-investment grade rating, still has value in my personal opinion. Okay, that's a quick run through of the credit ratings process and the credit ratings scale. If you've enjoyed this video, please subscribe to the channel. I will see you soon. Thank you for listening. Bye-bye.